Vanguard just published shocking new data saying retirees should have no more than about 30% of their portfolio in stocks. That's a major pivot when you remember this is the same Vanguard that as recently as 2023 and 2024 was describing the classic 60-40 mix as old standby with a stellar long-term record and a great starting place for long-term investors. So what's changed? And more importantly, should you actually follow this advice? Today, I'm breaking down what Vanguard actually changed, why they did it, and we'll explore a real case study so you can visualize what might be right for your retirement. Because the answer isn't 60-40 or 30-70. And if you stick with me, I'll show you what the answer is. But first, let me show you the shift. Vanguard literally called the 60-40 the reliable family minivan of portfolios and said it was poised for another strong decade. That was 2023 and 2024. Now their time-varying asset allocation model, built from their capital markets forecasting engine, recommends roughly 30% stocks, 70% bonds for a typical balanced retirement investor. Not 60-40, not even 50-50, 30%. Their target retirement funds follow a similar pattern, and they land at about 30% equity and 70% bonds by your mid to late 70s, and then they stay there. So whether you look at their model portfolio or their retirement glide path, Vanguard's message to the typical retiree today is clear. You might not need more than 30% in stocks. Now look, Vanguard isn't crazy. For some retirees, those who are significantly overfunded or extremely risk averse, 30-70 can work. But for most people planning a 30-year retirement, here's the problem. If you follow this advice blindly, you can lock yourself into a slow and quiet pay cut throughout your 70s and your 80s. At 3% inflation, prices double in about 24 years. So if your portfolio only creeps ahead of inflation after taxes and fees, your real income is actually going backwards. So you're not going broke, and it won't feel like a crisis in any given year in retirement, but over a decade or two, your lifestyle will get trimmed down bit by bit. Now, layer in opportunity cost. A 1% lower annual return from a 30-70 versus, say, a 60-40 over 30 years on a $1 million portfolio is not a rounding error. That can easily mean 6 figures less for lifetime spending and what's left over at the end for your heirs. We'll walk through actual numbers in a minute so you can see what that gap really looks like. And that shortfall doesn't show up when you're 65 and flexible. It shows up when you're older, less able to adjust, and facing some of the most expensive years of your life potentially, whether it's medical costs, long-term care, helping your family, or maybe taking care of a surviving spouse. That's when a too conservative portfolio stops feeling safe and actually starts feeling more like a trap. There's also a hidden bet baked into the 30% stocks. You're betting that inflation is going to stay tamed over those years, that bonds are going to continue to deliver big over that time, and that you don't live meaningfully longer than the average. Because 30% in stocks only looks safe if all of those really cooperate, or at least to a certain degree. If just one of them breaks, whether it's super high inflation, lower bond returns, or a longer than expected life, that safe choice can quickly turn into one of the riskiest financial decisions you'll make in retirement. Now, let's take a look at a case study. For Alex and Jamie, they're both 59 and they plan to retire next year. They saved about $1.8 million and they want to spend $130,000 in their first 10 years of retirement and then ratchet that back. When we run the numbers in our planning software, it actually shows that they could spend closer to $140,000 in the first 10 years and still be on solid footing. So that's what we like to call their safe spending capacity. So the big question is, how should their $1.8 million be invested to support their lifestyle for 30 plus years? First, let's look at a 60% stocks, 40% bond portfolio. Our software assumes an average return of 4.8% per year after inflation, with about 9.7% standard deviation or volatility within the portfolio. So this isn't a super aggressive portfolio, but more of a balanced one. Then we stress test it through thousands of market scenarios: high inflation, low inflation, early bear markets versus later bear markets, great decades versus lousy decades. And we ask, if Alex and Jamie spend at their planned level, how often does this plan work and what's left at the end? So let's explore that right now. 73% of the time, their plan comes in above what they were planning to spend throughout retirement. On average, those good paths end up 34% above their planned spending. In the very best scenarios, they're 160% above their planned spending level, meaning way more room for giving, traveling, and legacy than they were originally expecting. Now, 27% of the time, the plan comes in below what they had planned to spend. On those downside paths, they're about 5% below the planned spending on average, which is not terrible, And even in the worst cases, the gap is about 22% below their target spending. Put differently, with 60/40, about 3 out of 4 futures look better than what we were originally planning for. And the bad ones are uncomfortable, don't get me wrong, but they're not catastrophic. Now let's look at the legacy chart for the end of the 30-plus year retirement. Worst case legacy shows them having about $2 million. Median legacy is about $5.1 million. And best case legacy is about $10.5 million. Now, of course, when you're projecting numbers out over 30 to 40 years, you have to take them with a grain of salt. So with the 60/40, even in some pretty rough markets, Alex and Jamie are still on track to have roughly what they started with at death, and in many cases, significantly more. Next, we can say, okay, well, what if Alex and Jamie get nervous about stocks and decide to be much more conservative? So we'll flip the script and we'll look at 30% stocks and 70% bonds. Now, the software assumes the average return is going to be about 3.3% per year after inflation, with a lower volatility, about 6.9%. So on paper, it feels safer, less ups and downs compared to the market. But when we run the same thousands of scenarios with the same spending, here's what happens. Only 42% of the time does their plan to end above their target spending. Those good paths average about 26% above the plan, which is less upside than the 60/40 portfolio. And the best case is about 127% above the plan. Still very good, don't get me wrong, but much lower than that with the 60/40 portfolio. A full 58% of the time, the plan ends up below target, which might be surprising because you might be thinking, well, we reduce volatility in their portfolio, so they shouldn't have as major market swings, and thus they should have less years of reduced spending due to the market. And I'll answer that in about a second, but we can see on their downside pass, they're about 10% below plan on average, and worst case scenario, they're about 29% below plan. So with the quote unquote safer 30/70 mix, the chance of needing to cut spending more than doubles from 27% to 58% of scenarios below plan. When cuts are required, they're deeper and more painful since our 60/40 portfolio, the average shortfall was 5% compared to 10, and then the worst was 22% compared to 29% for the 30/70. Now, look at the legacy outcomes for the 30/70. The worst case legacy is about $1.5 million, $1.4 million. The median legacy is about $4.2 million, and best case legacy is about $6.9 million. Compared with a 60/40, Alex and Jamie are giving up roughly $600,000 in the worst case legacy scenario, about $850,000 at the median, and over $3.5 million in the best case scenario. So when you look at those two portfolios side by side, the surprising conclusion is this: the quote unquote safer 30/70 portfolio actually raises the risk for Alex and Jamie that they're going to have to cut their spending and lower their lifestyle throughout retirement because their portfolios simply can't keep up with inflation over 30 or 40 years. The 60/40 mix, even though it has a bit more stock market movement, it gives them a much higher chance of never having to trim their spending, and it leaves them with more money later in life, whether it's for healthcare, flexibility, or to pass on to their family. That's why in retirement, the most important risk to manage isn't necessarily market volatility. Although that is important, it's the risk of having to permanently downgrade your lifestyle every decade. So I want to leave you with what I believe most retirees miss. And it's the fact that the exact allocation, whether you're 50/50, 60/40, or 30/70, it matters less than you think. What matters more is having a system that responds to what actually is happening in your portfolio, not just the general market. Following income guardrails, where you start with your safe spending capacity, and when markets do well, you allow yourself measured increases in your spending, and when markets struggle, you make temporary modest adjustments downward to protect your long-term plan, is just so important. I can't overstate that. This system adapts to reality and your human behavior, and it's going to allow you to enjoy more of your hard-earned savings earlier in retirement when you're young and more vibrant. Take Alex and Jamie from our case study and give them a 50/50 allocation with spending guardrails. The outcomes are going to be similar, if not way better, than either a static 60/40 or 30/70 because their spending flexes as the market changes. So the real magic isn't finding one perfect allocation for you. It's really in how the portfolio is built and it's managed around your specific plan. So we have the income guardrails. We have to consider taxes, different costs that are going to be associated with the portfolio, the risk-adjusted returns or your Sharpe ratio, and just overall flexibility to lead the life that you want to lead. Because at the end of the day, the portfolio should let you sleep well at night and maintain your lifestyle through various market conditions. That's going to be the right portfolio for you. And That usually requires more than just picking the allocation percentage. So I hope you found value in today's video. And if you did, click the link in the description or just scan the QR code on the screen to schedule a call with my team and see how we can help you with this. I appreciate you watching, and I'll see you in the next one.